Good day all. I am Dr.T.Arunmozhi, Assistant Professor and Head, Department of Commerce, KCS Kasinadar College of Arts and Science. I welcome you all for the presentation on Ratio Analysis Part 2 in the chapter Ratio Analysis in the subject Management Accounting. It is based on the curriculum of all universities on this subject. The contents are the concepts of ratio analysis and the terms used in ratio analysis. This diagram shows you the liquidity type of ratio, investment out to the shareholders, gearing ratio, profitability ratio, and financial ratio. Liquidity, it is the ability of the firm to pay its way. Second term is an investment or to the shareholders, information to enable decisions to be made on the extent of the risk and the earning potential of a business investment. Gearing, which tells you information on the relationship between exposure of the business to loans as opposed to share capital. Profitability, how effective the firm is at generating profits at given sales or its capital assets. Financial, it is the rate at which the company sells its stock and the efficiency with which it uses its assets. Terms used in ratio analysis. First, we move on to the current assets. Current assets, which includes debtors, stock, bills receivables, bank and cash balances, prepaid expenses, income due, and short-term investments. The quick assets, current assets, minus inventories, minus prepaid expenses. The absolute liquid assets, they are the super quick ratio. This is a variation of quick ratio. This ratio is calculated when liquidity is highly restricted in terms of cash and cash equivalents. Working capital. We move on to working capital ratio. Measures the effective utilization of working capital. It also measures the smooth running of a business or otherwise. The ratio establishes relationship between cost of sales and working capital. Higher sales in comparison to working capital indicates overtrading, and lower sales in comparison to working capital indicates undertrading. A higher ratio is an indication of lower investment of working capital and more profit. Receivables. A business concern generally adopts different methods of sales. One of them is selling on credit. Goods are sold on credit based on credit policy adopted by the firm. The customers who purchase on credit are called trade debtors or book debts. Debtors and bills receivables together are called accounts receivables. Now we move on to the term payables. A business concern usually purchases raw materials, services, and goods on credit. The quantum of payables of a business concern depends upon its purchase policy, the quantity of purchases, and suppliers' credit policy. Longer the period of payables outstanding, lesser is the problem of working capital of the firm. But if the firm does not pay off its creditors within time, it will adversely affect goodwill of the business. Now we move on to the term fixed assets. Those are assets which are purchased for long-term use and are not likely to be converted quickly into cash, such as land, buildings, and equipment. Fictitious assets are the assets which has no tangible existence but are represented as actual cash expenditure. Next is the intangible asset. Is an asset that is not physical in nature, such as goodwill, patent, brand, trademark, or copyright. An intangible asset can be considered indefinite or definite, like a legal agreement or contract. Next, we move on to capital employed. It is a funds employed, or it is a total amount of capital used for the acquisition of profits by a firm or a project. We have the investments, investing money for profit. Current liabilities, it is an amount due to be paid to creditors within 12 months. Meaning of debt, it is the sum of the money owed or due. Meaning of equity, it represents the amount of money that would be returned to a company shareholders if all the assets were liquidated and all of the company's debt was paid off in case of liquidation. Cost of goods sold. It is a direct cost of producing the goods sold by a company. The amount includes the cost of the materials and labor directly used to create a good. Next, we have with the long-term funds, cost of sales is also cost of goods sold, represents the direct cost related to the manufacturing or purchasing of a good that is sold to a customer. Long-term funds, we have with the debt funds, which is invested in long-term debt, securities and money market investments. Long-term loans are loans which are repayment is spread over a longer period of time. Hope you would understand the terms used in ratio analysis. We would meet again in the ratio analysis part 3. Thank you.